Coming up, the inflation fall stalls. We'll speak more about the markets and AI, and profit reporting season continues. Hi everyone, it's your daily 10-minute business and finance news wrap for this Wednesday, the 28th of February 2024. We'll be speaking with Martin Lakos from Macquarie about the day on the share market a bit later, including all this hype around artificial intelligence. But first to consumer prices, where the Bureau of Statistics says the monthly CPI indicator remained at 3.4%. But right now, prices for staples, things like bread and dairy, are still higher than where they were a year ago. Rents are 7.4% above January 2023 levels, and insurance and financial services 8.2% higher. They were offset, though, by falls in meat and seafood, recreation and culture, and a big one, holiday travel and accommodation, which declined more than 7% on the year. So, what does this all mean for the future direction of interest rates? For that and more, I spoke with CBA Economist StephenWu.
So I think today's data really supports our view that inflation is coming down in the economy, and the RBA can be less worried about inflationary pressures running above their inflation target. So we still remain of the view that we should see inflation back to 3% by the end of this year. And today's data, which showed inflation steady at 3.4%, is supportive of that view.
What does it really say about how the cost of living is impacting people disproportionately?
Yes, you're right that the CPI indicator does have a little bit of drawbacks or shortcomings. And one of them is the fact that in the first month of each quarter, it typically does skew towards more goods prices being measured as opposed to services. So you're certainly right. We are seeing that goods disinflation is coming along and is supporting disinflationary pressures. What we don't really know right now is how services will track over sort of this year. We did get a read on rents, which is a key part of the CPI basket that's continuing to run at a very solid clip, and just reflecting the fact we have very low rental vacancy rates. That's going to support inflation over the year ahead. You're also right as well in the fact that we are seeing disparate sort of impacts of inflation. And I think the best way to kind of break it out is actually not by goods or services, but by discretionary and non-discretionary inflation. That's where we really are seeing that difference, where things of staples are still seeing relatively large price rises, but in discretionary things, so things like household goods or clothing, we really are seeing that come down. And even for like travel, for instance, we did see a pretty chunky fall in international travel and accommodation in the month of January.
So putting that all together, what does it all suggest for consumer prices and the implication for interest rates?
Yeah, so while the headline rate was unchanged at 3.4%, a lot of the various underlying or core measures ticked down in the month by about 0.1 or 0.2 percentage points. So that's showing that once you take out some of those volatile items, we are seeing continued disinflation. And again, does suggest that the RBA doesn't have to be so worried about inflation sort of staying higher for longer. The natural implication of this is that we think in terms of interest rates is that rates have peaked and the next move is going to be down. So if the RBA can be more confident that inflation will return to their inflation target, then they're going to be more concerned about the soft activity data out there. So in particular, we know the unemployment rates risen about half percentage point over the past couple of months to 4.1%. We know we've had 3 consecutive quarters of GDP per capita contractions. So that's going to be causing them some concern, in terms of downside risk to activity. And if the upside risk to inflation recede, becomes more balanced or even to the downside, then it should mean that the RBA can be more confident and start considering rate cuts. And we think they'll come through from September of this year.
That is StephenWu there from the Commonwealth Bank.
Now, Market Day on the SBS On The Money podcast.
The Australian share market was little moved today. The S&P ASX 200 down just 0.03%, 7,660. For more on the day's market action, including why so many investors are excited about artificial intelligence, I spoke with Martin Lakos. He is a division director at Macquarie Private Bank. Martin, first of all, what's driving the market today?
Well, Ricardo, we've been in negative territory for most of the day, but not dramatically so. And obviously, we're still in the middle of the company reporting season, so a number of key results came out. But we've certainly seen a better performance from a sector perspective in the lithium stocks, in the insurers, and also in the tech space, particularly driven by NextDC's result.
Before we go into all those results, I want to talk about the broader economic space. Inflation remaining steady at 3.4%. What's the market now thinking about the direction of local interest rates, especially in the context of other places around the world, namely New Zealand? While rates were left on hold there was talk of a potential rate rise.
Well, there's still a risk of rate rises if we get an inflation number that is unexpected, in other words, higher or meaningfully higher. But this number that came out today was a monthly number, 3.4%. It tends to concentrate on data from the goods sector. So we definitely know that goods pricing is starting to come down and has been for quite some time, but very little data out of the services component. And that's the area the Reserve Bank has noted is a lot stickier than they would like to see. That is things like wages and rent. So what we're really waiting for to see if there's any dramatic change in the inflation data is the March quarter data, which will have a lot more information for the market and the Reserve Bank. And we would expect that out by the end of April. Now, it's not Macquarie's central view that we would see a change in rates by the Reserve Bank on that quarterly number. On what we're currently seeing in terms of the downward momentum for inflation, we have an expectation of our first rate cut in August, followed by another one in November. But there is a very slim chance that if the March quarter numbers were substantially better, that is lower inflation, it's possible it lines the Reserve Bank up for a cut as early as May. But that's not our central theme.
Okay, you touched on profit reporting season. We're coming toward the end of it right now, but of the ones that reported today, which ones caught your attention and why?
Well, I guess the way they catch my attention is to see what the stock prices react to, Ricardo. And the good result was NextDC. That was reacted by the stock price up 11%. The market very much liked the commentary around their involvement in AI. And as a result of which, they're seeing quite a bit of interest and contracts starting to come through for the rest of this year. So the market got very excited by that. So that was a good performance. Overall, though, they did see property holding costs higher than they had anticipated. That sort of put a little pressure on some margins, and the headline result was slightly softer. But the focus by the market was clearly what the outlook is on AI for the rest of this year. The second result was Flight Centre, which the stock reacted negatively, down about 6%. And again, it's probably a late cycle play in terms of seeing confidence by the business sector starting to spend on things like on travel, and also the consumers to some extent have seen some pullback. There were parts of the result that did somewhat disappoint, and that's what's come through in that negative 6% performance by Flight Centre's share price.
And given that we are close to the end now, how would you rate reporting season?
Well, I guess we really have seen a period of two halves. The first half was much better than anticipated in terms of expectations of results. We saw better top-line growth, probably better, more stable margins, which is quite good, and a pickup in some instances on dividends. Now, that's not across the board, but that we certainly have seen more beats than down results that had been anticipated. So that's clearly good news. The start of this week have seen some more mixed results, although still positive, and it's fairly typical that the second half is a little bit softer. But I guess the way it seems to be panning out, the domestic cyclical stocks are reporting better than expected results and better than expected outlook statements, and the resource sector is really the sector that's probably disappointing somewhat. So overall, we'd have to say not a bad reporting season, and it may well turn out to be the bottom of the earnings cycle.
Can I pick you up on one thing? You mentioned the two letters that everyone's interested in at the moment, AI, when you were talking about NextDC. When I read through the Flight Centre results, Flight Centre also said it's spending a fair bit of money on AI technologies as well. There's been a lot of attention on big tech, especially out of the US. NVIDIA with that outstanding profit number and earnings forecast, which it came out last week. Today, reports Apple is dumping its EV plans to focus on AI. I just want to get your perspective on the world of tech and the influence it has on the market at the moment.
Well, I guess we've seen the Magnificent Seven being the big outperformer, what we'd probably call the tech utilities, over the last 3 to 4 months in particular. And I guess to some extent it's worth noting that NVIDIA's share price this time last year was about $240 a share, now a touch under 800. So we've seen a phenomenal performance out of that stock, and some would suggest that it's a bit of a bubble in the short term, that it's overdone from a valuation perspective. But clearly, they're seeing very strong revenue growth and very strong profit growth. Whether the valuations justify the current share price is another issue. But it is interesting to see that Apple have decided to pull their expenditure and development and planning on developing an electric vehicle, and basically rediverting both resources, so people and funding and investment, towards AI. And for them, it's going to be both a focus on chatbots, for example, as well as which they've already started to develop new AI headsets and eyewear. And they see that device side, which is their area of specialization, obviously a very big potential for them. I guess to some extent, some people are viewing AI as a threat, and for some industries, it may well be. But it's a bit like when technology really started taking off 20 years ago, that those businesses that don't start thinking about innovating or taking up new technologies, they do get left behind. So I think it's very much a contentious view at this stage, but I think also we are expecting to see a lot more businesses coming on board in terms of using and benefiting from AI over time.
That's Martin Lakos there from Macquarie.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.